friends, it's 𝐸𝐸 again, Portfolio Manager at Piggy Bank Asset Management. In the last video, we dipped our toes into the world of private equity. This time, I will expand it a little bit and show you the 3 typical stages of a private equity investment. To make it easy, I'll use the same example, 𝐸𝐸's ice cream. Imagine one day 𝐸𝐸 decides to retire from her portfolio manager career and become an ice cream entrepreneur. Let's scoop into that. Stage 1. Venture capital, or VC. When a dream becomes reality. Alright, picture this. 𝐸𝐸's ice cream shop was just a sweet dream in my head. I've got killer recipes for different types of ice cream. The classic rich and creamy, the trendy vegan sea salt caramel swirl, and the guilt-free sugar-free mint chocolate chip. But I'm short on cash. This is where venture capital, or VC, swoops in like your favorite toppings bar. Those VC firms, or as I like to call them, dream makers, can help me turn my frosty fantasies into reality. In return, they take a small stake in 𝐸𝐸's ice cream. Now let's talk about risks. In 𝐸𝐸's example, I was a portfolio manager before. I have 0 experience running an ice cream shop, so the VC firm is taking a big gamble here. Before funding my shop, they'll need to evaluate my business model and make sure I've got growth potential. From 0 to 1, this is the stage of venture capital. Some people actually don't see VC as private equity because VC investors usually invest in younger, growing startups and only take a minority share of the target company. But technically, VC is a type of private equity. It's the early stage. As a matter of fact, there are different stages within the VC life cycle, such as the seed stage, the angel round, etc. But we can save that tasty morsel for another time. Stage 2. Growth equity, or growth capital, a growing child. Fast forward a few years, 𝐸𝐸's ice cream is a neighborhood sensation. We've got lines out the door, rave reviews online, and influencers snapping pics like crazy. It's time to expand. We need more stores, more locations. This is where growth equity comes into play. At this stage, my shop is already a hit, like a growing child. That's why the investment in this stage is called growth equity, or growth capital. When I want to take my business to the next level and enter new markets, a private equity firm can be a helping hand and make that happen. And again, they will take a piece of my shop, so when I make money, they make money as well. The risks at this stage are smaller since I've already proven I can scoop success. With extra capital, we're turning this shop into an empire, one delicious scoop at a time. Stage 3. Leverage buyout, aka LBO. College graduation. Now imagine that 𝐸𝐸's ice cream has become a brand, a legend. You see my shops in all the major cities. Yay, I've made it. What's next? Let's say at this point I've achieved my dreams of scooping happiness. I just want to take loads of cash and move to Hawaii, so I'll sell my business. This is the exciting part that most private equity firms want to jump in. They want to buy a mature company, repackage it and flip it, or help it go public. In this stage, the risks are much lower. After they buy the business, they are the new owner. They have the say to make changes such as improving management, cutting cost, and maybe even adding new flavors. Hey, but please keep my vegan caramel. You may be asking, hey 𝐸𝐸, you just said leverage buyout. Where's the leverage part? For that, I'll expand a little. A private equity firm, let's use Rich Friend Capital again, is buying 𝐸𝐸's ice cream for $1 billion. 𝐸𝐸 is definitely taking that billion and say aloha. But Rich Friend Capital isn't coughing up the whole amount themselves. Normally, they'll only put down 10% from their pocket and take out a loan for the remaining 90%. That's the leverage part, using the borrowed fund to achieve the buyout. Think of it like buying a house. You make a 10% down payment and take a mortgage for the rest. It's the same concept. Best case scenario, under Rich Friend Capital's management, 𝐸𝐸's ice cream turns into a $10 billion company in a few years. Rich Friend can sell the company to another private equity firm, cash in and walk away. Party time. Key players, GP and LP. Now you know the 3 stages of a typical private equity investment. Let's introduce the key players. GP, which stands for General Partner, and LP, which stands for Limited Partner. General Partner, or GP, here is the private equity firm. They are the manager of the LP's money. They look for good deals in the market and try to make profits for the LPs. On the other hand, LPs are the investors. They provide money to the GP to manage and invest. In the case of 𝐸𝐸's ice cream, Rich Friend Capital is the GP. They launched a fund for this acquisition. The money of this fund comes from the investors, which is the LPs. These LPs can be asset management companies, financial institutions, super wealthy people, pension funds, and college endowment funds. GPS receive management fee and a share of the fund's profits. In many cases, there can be multiple GPS participating in the same investment. To sum up, a private equity investment grows from a dream to a mature company ready to become a big name. From the initial venture capital stage, through the growth equity phase, and finally to the leverage buyout, each stage plays a crucial role in the life cycle of a business like Moo Moo's Ice Cream. I hope you enjoyed this video. Please don't forget to give a thumbs up and subscribe for more financial education videos. If you have a topic that you want me to cover, please comment below. Until next time, happy investing. Peace out, Piggy Squad.